This is a great question. I get this all the time. How is my credit score impacted when you pull my credit report? There's a lot of misinformation out there. Hi, Greg Janeel here from Janeel Financial Group, and this is our 7th video in the series, and it is, how is my credit score impacted when you pull my credit report? This is a great question. I get this all the time. There's a lot of misinformation out there, and basically, you're allowed to shop for different lenders and different mortgages. If you hear someone saying, don't go and pull my credit because they don't want your score to drop, if I pull your credit and a bank down the street pulls your credit in the same week, it's likely that we'll have the very exact same score on both credit reports. Why? You're allowed to shop for a mortgage. If, for instance, you were having multiple pulls for different reasons, that will affect your score. It'll start to drop it. If you have a pull for a boat loan and a car loan and a motorcycle and some credit cards, they're going to go, oh, geez, that's a lot of different pulls going on at once. What's going on with it? And that may affect it. If a mortgage person pulls your credit report and 30 days later another mortgage person pulls your credit report and they have a different score, the most likely reason is that your credit card balance is updated and that affected your score, not necessarily the two mortgage related pulls. Inquiries on my credit make about 10% of your score. So I do have a little cheat here, and I'll tell you exactly what my FICO score, right from my FICO score or myfico.com says. Your FICO score, 30% is made up of the amounts you owe. 35% is your credit history, your payment history. Only 10% is new credit. 15% is the length of credit history you have. Another 10% is your credit mix. You're not going to get hammered if you go and pull your credit for a mortgage to get pre-approved. It's a misnomer for sure. You can affect your score differently. It's really, once you understand how credit scores work, if you have additional money set aside but you have a high balance on a credit card, you may want to apply that to the balance on the credit card and get under 50%. For instance, one time I went to Best Buy. I was buying $4,500 worth of TVs and all that stuff. They ran my credit and they said, oh, Mr. Janeel, you're approved for $10,000. Would you like me just to do it for the $4,500? Absolutely not. If you do it and now my balance is $4,500 and my credit limit's $4,500, it looks like I'm maxed out. And they compare me with every other person that has a maxed out credit card. They may be going through foreclosure. They may be going through bankruptcy. And so they're going to compare me. If I have a $10,000 limit and now I have a $4,500 owed, they're going to compare me with everyone else that has a less than a 50% balance on their credit card. It's important to understand how the balances of your credit and how you're using your credit affects, because it's 35%. Your payment history is another 30. It's important to learn how those interact with each other, especially right before you're getting a loan. I'll tell you, oftentimes, I know I'm about to make a big purchase. I maneuver my money and credit around, so I know I'm going to have a 740 score or better when I go and apply for that. And then in the meantime, it just rides wherever we need it to be. If you ever have any questions about that, feel free to give us a call. This is Greg from Janeel Financial Group, President and CEO, and go out and make it a great day.